Hi everyone, so I'm up 10.24% year to date realized in 2025. So this is through January and February, and I want to go basically break down every single trade that I've done. There's not too many of them. There is about, I believe, five or six of them. So not too many, but I think it will be really good for me to explain my neutral method, because I only trade neutrally, and also want to speak about my options academy for those who want to, I guess, just gonna learn and pick my mind and basically like mirror trade, and then ask me questions and kind of see how I make decisions and why I make certain decisions, because I think it's important. And at the end of the video, I'll go over my strategy as always. So let's begin with the first position. It was in January, so it was a ZL position, soybean oil, and I opened it on January 12th. So on January 10th, there was a pretty big report for the grains for soybean oil, and volatility spiked up. So I opened my position and I closed it early at 43% of credit for the profit, where my take profit is actually 50%. The reason I closed it, and I have the reasoning here. So this is the Options Academy. This is where I post all my trades basically. So there's the reasoning for the entry. CVOL was great, which is the commodity volatility index, which I will go over in a second. And the range to the stop losses was very, very good. And it was a pretty good position overall. As you can see, the WSDA report was on January 10th. And the reason for exit is the trade profited pretty much quicker than I expected. And then, as we all know, Trump at that time, he said he might impose tariffs on Canada and Mexico, which can influence the price of soybean oil. And this is a geopolitical situation which I don't have any experience with, so better be safe than sorry, especially if the position is up that much. And this is the position basically. These lines are the lines that are stop loss. These are not the short strikes, which is really important to know. The short strikes are maybe a bit wider, but basically I want to go and see, okay, what is my range to the stop losses, and for how long was the price moving within this range. So in this case, technically the price, well, if you don't consider this, the price was within this range since October of 2023. So well over a year at that point, a year and 2 months, give or take, when I opened the position. So for me, it was a really good range, and you can see the price is kind of moving within this tunnel. So I actually opened a skew triangle just to kind of make those stop losses basically occupy all the price here, and it was a pretty good position. And if you look at the CVOL, so let me show also what the CVOL looked like, because I think it's really important. So we opened it actually on Sunday, on the 12th, on Sunday 8 p.m. when the market opened, but let's see here it will probably show a Monday. So sorry, not February, but January. So you can see volatility was, pretty high, relatively, for the previous few months. And so I opened the position, and obviously volatility went down, and which is exactly what we want. And the position profited pretty quickly. So this is for the soybean oil position. It was, I guess, pretty self-explanatory. First thing is I'm always looking to see if I can get a really good volatility through the commodity volatility index. Second thing, I want to see, okay, can I get a good range for my stops? And then obviously, this is pretty much the two major things. Good volatility, and also do we have a good range. Actually, a good range is better than even having a good volatility. That's number one basically for me. But this trade worked out pretty well in just, I believe it was 17 days. Really, really quickly, and I closed it before the end of the month. And then obviously we know that Trump postponed the tariffs on Canada and Mexico until March, and we'll get to that as well, because I also closed all my positions for this month as well, or for February. Now, second position is I opened a ZW position. So CVOL was pretty much really high. And the thing is, I closed this position again pretty quickly when Trump announced the tariffs. So again, I didn't know. I closed the position only for 5% profit on credit, so really low. Nothing too interesting about this position. I'm not going to waste any time going over this position. I just want to maybe go over the volatility. So the position was open on January 23rd. So if you look at the CVOL, so the volatility for January 23rd, we can see it was actually really, really high, which is, again, exactly what I'm looking for. Good volatility, and then obviously I closed the position pretty quickly because Trump actually ended up announcing that he will, for sure, put in the tariffs at the beginning of February, which obviously we know didn't happen. But at the time, I have no way of knowing. And if there's one thing that I know for the commodity trading, is better safe than sorry. I've been doing it for almost 9 years at this point, so this is why I closed this trade. And these were the only 2 trades for January. And obviously, I sell some T-bills, but this, it's just a little bit of profit. Now, for February, so I opened 2 positions on crude oil and silver on the same day, so on February 3rd. And what happened on February 3rd? Well, if we look at the reasoning, CVOL was pretty flat for crude oil, which is completely fine. The range was really good for the stop losses. And Canada and US came to an agreement, so the tariffs are paused for now. At that point, Trump postponed the tariffs up until March. So I felt pretty good opening the position on crude oil, since Canada exports a lot of its crude oil to the US. And I felt like volatility will go down, which it actually was actually what happened. And if we take a look at what happened for the volatility for crude oil, it was pretty flat for the most part. So if we look on February 3rd, so it was pretty flat. So it's a bit misleading here, but basically volatility was pretty flat all along. So this is why I felt completely fine opening the position. For me, I want to open a position if I see volatility is flat or if it's high, basically. So it's a bit, it's, I guess, not quantifiable as easily as I say it. Because if you, for example, zoom in, so this looks like volatility is spiking up and down, but in reality, this is actually not really big jumps. This would have been a big jump, but here it's more flat. So this is something that comes with experience, and just kind of going through the seasons with those products and seeing how volatility affects the positions. Well, volatility was flat, so I felt completely fine opening the position. The range to the stop losses, again, these are the green lines. These are not the strikes. You can see the price was moving within this range since June of 2023, so a year and a half. So the price has been moving within this range for a year and a half. Nothing better you can ask for, really. And obviously, I ended up choosing to close this position to exit early for a 26% profit of credit. So far from the 50%, but it is what it is. Just because Trump postponed tariffs on Canada and Mexico until April, but then he moved it back to March 3rd. So I really don't know what's going to happen. When he announced that he will be bringing the tariffs back on March 3rd, it did affect the position. So he went from about 30 to 35% profit to 26. So I decided to just close it. There's no point in risking and trying to find out what's going to happen when the tariffs come into effect, or how the market will react. And the US dollar is also went up. So obviously the crude oil is tied to the US dollar. So crude oil went down. I don't know. Again, I don't know what's going to happen. It's not my job to know what's going to happen. My job is to manage risk and take advantage of opportunities and avoid scenarios or situations where there even is a slight chance of things going wrong. Especially because I'm neutral, so I need the price to kind of stay. I don't care if it moves up or down. I just don't want it to move really sharply, or I don't want volatility to explode in my face. And obviously, it's been really good for me again for the past 8 to 9 years because of my approach, and because of my, I guess, being afraid of situations. But this is what kept me in the game, and I'm really proud of it, and I just gain more and more confidence in my approach of just not chasing profits, but rather being really, really careful with my positions. And also, one thing to note, my stop loss was at 40%. This is something that I updated going forward from the beginning of February, just because the difference between 40 and 50% stop loss is really, really small on the graph. But at the end of the day, the numbers can really, really work in your favor down the road after you have quite a few positions on, because you can risk the same amount in terms of the account percentage. So I risk about 3% of the account to make almost close to 4% because my stop losses just went down, but the risk is the same risk, but the profit actually went up. So this is really, really good for me. Been 26 days in the trade, so not too bad. But this is basically the reasoning for me to open and close this position. Now we have silver. The reasoning to open this position, it's basically the same as crude oil. I opened silver exactly on the same day that I opened crude oil, and this is because Mexico, they produce and export, or they're the biggest single producer and exporter of silver in the world. So obviously, when when we saw that Mexico made a deal with the States for the tariffs, and the tariffs were postponed, then it was also a good position for me to open a trade on silver. As you can see, the lines for the stops, and these are again 40% of credit, not 50%. And we can see the price have been in this range since September. So it's about, at the time, it would have been about 5 months. So basically anything over three months is considered pretty good overall, based on the DTE that I'm trading. And as you can see, the DTE is over 100 for all these trades. And this is specifically just because the prices are way more volatile this year and also the previous year. Some years I can definitely trade with 40 days to expiration, 30 days to expiration. It just depends on how volatile the market is and what is my range. At the end of the day, again, I want good volatility, and I want to make sure that I have a very, very safe and good range to basically avoid all the noise in the market. So if you look at the volatility index, see here for silver, on what was the day? I already forgot. February 3rd. Again, it was pretty high up, which is again very, very welcomed. And I usually look at the volatility for the past 3 months. This is what I really care about. It depends. So for example, I would not count this volatility as high because at this area or at this period of time, this is where we had the elections for in the US. So volatility was high across everything basically. So this is a different era. And then from this point, I guess this is what the volatility that I would be counting towards, seeing if this is a high or low volatility over here on February 3rd, which was sufficiently high for me. And again, volatility went down. And this position, I closed it, I already forgot, at 33% of credit. So not too bad. It went all the way to 40% of credit. So it was really, really close to getting, obviously, closed. But it is what it is. I'm here to manage my positions and manage my risk. And I need to know when to be more careful with the market. And this is definitely the time to do so. Now, the third position was again a weak position, and again I closed it pretty early for only 14% of credit, positive, 18 days in the position. Now I opened this position because the stop losses were pretty amazing, and there was no upcoming events or news coming out, and there was nothing crazy on the WSD report. So this is the World Agriculture Supply and Demand estimations, I believe. And they had a report on February 10th, and nothing happened, no massive news. So I decided to open this position on February 11th, so basically right after the report came out. And here again, my stop loss was at 40%, and you can see the DTE. Now for days to the expiration, 129 is definitely a lot. The only next expiration that was available was at about 77 days, which did not give me a good enough range to my stop losses. So let's go over and see the range to the stop losses, because it's really important. So you can see these lines are my stop losses basically, and the price was moving within this range since June of 2024. So this is a nice 8 months. So 8 months within this range, amazing. As you can see, the price just kind of kept plummeting down, still kind of goes down because of the tariffs, because Canada and Mexico, they export a lot of their wheat into the US. Now, if we take a look at the volatility here, which is also, I think, a bit important. So, open it on February 11th. So right here, so volatility was relatively high. As you can see, it was a pretty good volatility. I was pretty happy about it. It was definitely on over the 80th percentile, so it was pretty good. It went down, The position was up as much as almost 25% of credit, which is really, really good. And then I only closed it for a 14% profit on the credit, just because the price really just plummeted down. But again, this game that I'm playing basically is where I want to be. I want to position myself where I can be wrong and still make money, or I can be extremely wrong and still make money. And this is, again, the biggest things that contribute to it is a good range to the stop losses because I'm neutral, and also a good volatility, which is really the biggest two things. Among the two, the more important aspect is definitely the range, because usually if you have a good range, then volatility is probably good enough for you to open a position. Again, it depends on how many days to expiration, but generally speaking, this is what I want to be looking at. Now, again, if you're interested in joining my Options Academy, just email me with my email address below, and we'll see if we can get you in there. There's no upfront cost for it at all, but let me know and we can go over the details. Now, this is my strategy. Hasn't changed in years and years and years. Maybe you can see that right now I don't trade basically LEHE in any of the futures currencies. I only really stick to the top 10 here. From ZL and all the way up to GC, and it depends on the time. So sometimes some years you can trade the euro and any of the futures currencies really well, but this is not the year, so I'm just not really looking at them too much. Same with the meats with LE and HE. Now it says 45 days and less. Historically, this is what I've been doing, but obviously depending on the year, depending on what's going on, I want a good range. So whatever DT will give me the best range, this is the DT I'm going to go for. Some years like 2023, like 45, even 30 days to expiration was really good. Sometimes even 27 days to expiration, like 25. Some positions were really good. It all depends what the price is doing. But again, whatever DTU gives you the best range. Now, I pretty much only do short strangles. Here and there I can do short calls and short puts. Probably maybe less than 0.5% of the trades are directional. I just really like neutral. It makes much more sense to me. My short strikes are always around delta 20 for the neutral positions and around delta 35 for the directional positions. My profit target is 50% of credit, and my loss target is up to 50% of credit. Currently it's about 40%. Again, it depends on what range you can get, and you work from there, but I don't risk more than one to make one. Ideally, right now I risk $1 to make $1.25, which is really good. And the stop loss is dynamic, meaning if I'm up 25% of credit, I'm going to move my stop loss to negative 25% of credit. So usually I just keep that 50% difference from the current position P&L and my stop loss to a certain point, and then obviously either the position will end up profiting the full 50%, or I might exit early, or you will hit the stop loss. So I will always use the CVOL for good entry, which is the commodity volatility index, which we went over. And this is basically it. There's nothing too much to it. I think I gave away pretty much everything I do. I think the only unique thing that I have that is not in this video is just experience and a way of interpreting what is a good risk and what is not, and when is it best to exit the market and when it's not. I think this is the only thing that I might have that did not translate in this video, to its fullest. But everything else, I think I laid out pretty easily, simplified it as much as I can. My exit rules are really simple. Either the profit target or loss target are hit, I can exit 21 days to expiration to avoid gamma risk. I can adjust my positions. Never happens, basically. Never ever happens. Maybe once or twice in like a few years, but usually never happens. There's no point to do it. I just take a loss if I need to, and I can exit early due to certain reasons, like I explained in this video. If something is some geopolitical situations where I have no experience with, where I don't know what's going to happen, there's no point for me to try and gamble and stay in the trade. I can just watch over from the side and then open a position later on if everything is okay. Now, the last thing that I will say is very important is I'm always just looking for a good opportunity where the risk is worth the reward. My job is, again, just to take advantage of opportunities in the market, manage my risk properly, and this is basically it. There's nothing else. Nothing else to it as a trader, especially as a neutral options trader on commodities. Now, thank you so much for watching. And again, if you have any questions, let me know. You can email me for the Options Academy if you're interested. And thank you so much. And I will keep you posted as the year goes. And hopefully it will be a good year for everyone. Thank you so much, and I'll catch you in the next one.